Loretta Cross is managing partner for corporate advisory and restructuring services at Grant Thornton. She joins me now. A quick reaction here to another idea echoed not only in the press but right now by Mr. Riley, that we could see the moratorium on drilling in the Gulf of Mexico lifted before the end of November. Does that change the picture for the companies doing business there in a true sense?
I don't really think it does. I think that really what's happened is that because of the spill, what you're really seeing is a number of companies have got to address whether or not the risk profile and the cost profile of doing business in the Gulf still fits their business strategy. And you're starting to see what I believe will be the beginning of a real consolidation of the Gulf. And so if you look at the number of players that currently produce oil and gas in the Gulf, they're made up of large, what we would call the big oil and gas companies like ExxonMobil, Total, BHP, and obviously BP. Then you move to the smaller independent companies like Anadarko, Plains Exploration, and then to some small companies like Energy 21 or ATP. So as you look at that, some of these companies, the largest piece of their cost is insurance, and that's today. And with insurance increasing by as much as 50% for these companies to continue to operate in water, that is a huge increase just from that alone. And that doesn't even have to do with the moratorium or government regulation, just the shift of risk profile.
The cost of doing business, it can be so heavy for those smaller companies. We lay out some of the ones you just mentioned there on our screen right now as potential sellers there, companies that might be incentivized to sell themselves to a bigger giant who can shoulder those costs. But then step back for me here, because the other big uncertainty is what's going to happen on the regulatory front, right? So does that make those assets less attractive? You might be able to get them for a song, but do you want to expand your business in this area?
Well, and that's exactly the point I think that makes a lot of sense to talk about, because what you're saying here is if there's going to be a consolidation and it ends up with ExxonMobil and BHP and Total and Shell and Chevron as the major participants in the Gulf, they have choices of where they want to drill worldwide. And until the regulatory position of the U.S. shakes out, it only makes sense for them to make decisions about their drilling programs where they understand what the regulatory impact is going to be and really what it is what kind of operating environment they're going to be in. I think that we're talking about someplace between 18 and 24 months that the activity in the Gulf will actually slow down. There'll be a lot of M&A activity and collapsing and a lot of transactions occurring, but actually new development may slow down for the next 18 to 24 months. Well,
when we look at M&A more broadly, we've seen a lot of activity, particularly this month. In oil and gas, though, on the year, there's been a tremendous amount of activity in the energy space. Oil overall, like $111 billion. Most of that's been focused in on explorers, though, not the drillers. Do you expect more focus on the drillers in particular?
I think that there's going to be a flurry of activity everywhere from oilfield service companies. In this particular paper, we focused on exploration and production companies, but oilfield service companies, exploration and production companies, marine vessel companies, anybody that has to participate. And the only way that they're going to be able to, a lot of these to compete is to have a broader focus, to have a larger platform, to be able to go global with the bigger players. And that takes capital, that takes time, and that takes changing your strategy.